Okay, looks like we got it. Okay. Hi, everybody. Welcome to our insurance strategies training. And I'm wondering if everybody, it says you can't unmute. I wonder if everybody has the correct link today. I'm going to go through some really, really good stuff. So I'm excited to be with you guys here. I'm wondering if we should wait another minute or two before we get started. Let's see. Brett, can you text me this link so I can just make sure that everybody has it?
I did. It's the second one that I texted you. So the one that says, here, I'll text it again, just so it's at the bottom of our thread. There you go.
Okay. Yeah, because I'm gonna go through some really good stuff today.
Yeah, the first link I used didn't work. It was
Same with us.
yeah.
Right. Okay. I think Veronica's gonna come in and out. Okay. Well, I'll go ahead and get started. So what I wanted to do is, I want to talk to you guys about comparing insurance policies. And I want to ask, first of all, so Maritza, you and I have already spoken and we kind of deep dived into your policy. And we're going to be showing you, obviously, the difference between, how one company versus another versus one strategy versus another could literally mean hundreds of thousands of dollars, if not millions of dollars of difference in your future of what you're actually going to have in these policies. But let's ask Veronica, Mandy, is this your first time on one of the insurance calls or have you been on one of our calls before?
This is my third one. But actually, I'm glad that you brought that up because I have a term policy that I was considering converting to whole life. But now that you're saying that, that kind of makes sense.
Okay, so you were
the same carrier. That's what I'm saying. Like, yeah.
What carrier is your term insurance with?
I think it starts with a P. Prudential.
Prudential. Okay.
Prudential. Yes.
So you've got Prudential term and you were looking to convert from Prudential term into a Prudential whole life?
I don't know if it's whole life. It's the one that has the cash value. I don't remember.
So whole life can have cash value and all other types of permanent policies can also have cash value. It just depends. And this is where we start to get a little complicated because there's like something called GUL, which is like guaranteed universal life, which is not going to really build cash value, but it's permanent coverage. Then you have a whole life, which is going to pay you dividends. It's going to still be permanent. It's going to also build cash value, but the way that the policy earns interest is different than the strategy that I'm going to share with you guys today. So let me just send this link to one more person. Okay, so I'm going to show you guys an example of kind of whole life versus the IUL concept. And so Veronica, that way you can kind of understand, yes, if you have term insurance serves a purpose. And we went through that on the first class where term insurance will cover you if something happens to you within that term. Now, even on the term insurance side, if you guys remember, we were talking about there's term insurance that is just for a death benefit. And then there's also term insurance that has living benefits, which can essentially have riders like critical care, chronic care, terminal illness. So term insurance goes into different categories as well. So if you're going to have term, you want to make sure that you have the right kind of term insurance. Okay. So the term insurance that you currently have, what kind of policy do you have? Is it 20-year term? Is it 30-year term? Is it 10-year term? Do you know what kind of term you have?
It's a 30-year.
Okay, awesome. And when did you get that?
I got it almost 10 years ago.
Okay, so you've got 20 years left on that policy. And do you know the term insurance you have, does it have living benefits? Meaning, does it have a terminal illness, chronic illness, critical care?
Mhm.
Are you
Yep.
sure?
Yeah, I think so because I pay extra for that when we set up the policy.
So you want to
Okay.
check, on that. If you bought it 10 years ago, it might have, so,
Yeah.
so you want to understand this stuff, see? So you might have an accidental death benefit rider on there. You might have a waiver of premium rider on there,
Yep.
right? Okay, so those are very different than a critical and a chronic rider. So if you have the waiver of premium rider, what that means is that if you had something tragic happen to you, they would allow you to stop paying the premiums on the policy and your policy would continue.
Mhm.
Okay, which is good, but all it does is it saves you money on those premiums when something has happened to you. The accidental death benefit rider, what that means is if you die in an accident, then they're going to like double or triple the amount that they pay your family. But the accidental death benefit rider almost never pays out. You literally have to die in the accident, meaning like if you like fell off the roof of your house and you ended up in the hospital for a couple of weeks and then you died, then they wouldn't pay it out. Like you have to die in the accident. So you're going to get flyers and, advertisements of like, oh, you can get insurance for $1 for $1 million of coverage. And a lot of times people buy this kind of insurance thinking that it's real life insurance, but it doesn't pay out. Does that make sense? So that's why you have to understand the difference between the accidental death insurance, the waiver of premium versus the terminal and the critical and the chronic illness rider, because those riders, the terminal illness rider is, God forbid, you have a stroke or you have a stage 3, stage 4 cancer diagnosis. They will literally pay you a big portion of the death benefit while you're alive to take care of medical issues. So it's not health insurance, it'll actually pay you. A critical or a chronic care rider can also be, a stroke, a cancer diagnosis, be Alzheimer's. There's like 50 different things that can happen. Could be a major car accident where you're in the hospital and you can't work. The policy will actually pay out a percentage of the death benefit while you're alive. So not many companies offer these riders. I don't believe that Prudential 10 years ago had that. So you want to check your policy to see. And if you're going to have term can be a powerful concept to have, but you want to make sure you have the right term. You want to make sure you have the right riders and you want to understand how these riders work.
Yes. It's very cheap though, because I got it in my 20s. And I pay like nothing.
Right.
It's very cheap.
So
So I can keep it, doesn't affect me at all.
So,
I'm saying.
right. So if you go to Google and you type in what percentage of term insurance policies ever pay out, it'll give you the answer. And it's like 2 to 3% of term policies actually pay out. So that's why it's so cheap, because 98% of the time if you buy it when you're in your 20s and then 30s, 40s, 50s, you're still alive, they never have to pay a benefit to your family. So it can be a powerful tool because it's cheap and it can give you a lot of coverage, but the chances of it paying out are slim to none. So the whole idea behind that is if you're going to buy term insurance, then you better get really good at investing and really invest the difference so that you build up your own wealth so that in 30 years or in 20 years, you don't need coverage anymore. And if you can commit to doing that, super powerful tool. Okay. So again, whatever choices you're going to make, you want to be empowered that you're making the best choice for you. Okay, so now I want to give you guys an example, and I'm going to screen share and show you a powerful case study that can literally show you the difference between having like a good policy, in my opinion, and having a not so good policy. And I'm never going to say that any policy is bad. There's just different concepts, but you want to understand how these things work. Okay, so let's pull up a case study here. All right, can you guys see my screen? Let's see if I can make it bigger. Let's go slideshow. Okay, you guys see this? Oops. Hang on. How do I go the other way? How do you go backwards? Hold on. Escape. Okay. Oops. Keeps going. Hang on. Escape. Okay. You guys see that? Okay. So in this situation over here, this right here was a client that had a policy, and it was a whole life John Hancock policy. And if you take a look, can you guys see my little pointer over here? Okay, so it says here, premiums paid. He was paying $7,300 a year into this policy. And do you see over here, the total death benefit was $1 million? So the client had this policy for 20 years. And he had current cash value of $263,000. So when I met him, he said, I already have insurance. It's whole life. I'm good. And so I said, okay, well, send me your statement. Send me the policy details so I can run some comparisons. And this is what I'm always going to say. If it's good, I'll tell you it's good. But if it's not so good, then I want to be able to share with you essentially what else is out there. So in this situation, if you take a look, year 21, he had to continue to pay premiums for the next 8 years of $7,000 a year. And the cash value was growing and it was getting paid dividends. But if you take a look over here, the death benefit stayed $1 million no matter how much cash value the client had. You see that? So even when the client in year 45, okay, literally still has $1 million death benefit with a cash value of 735. So this is where you'll hear people say, these policies are terrible. You have $700,000 of cash value, but if you died over here, you still only get $1 million. So this money is kept by the insurance company. Does that make sense? Does that sound like a good deal? Okay, it could be depending on why you're buying the policy. Depends on how you're building this policy. But he had to continue to pay these premiums. And after 8 years, the policy would be paying for the premiums from the cash value. So you see over here, so he pays in for 8 more years and then pays nothing. But this is his cash value going 5, 10, 15, 20, 25 more years. So here's what I want you guys to look at. In year 5, client still pays in $36,000 more in premiums, and he's got $359 in cash value after 5 years. So I took this illustration and I ran it with another company called Pacific Life. Okay. And what we did is we said, look, we're going to go ahead and move over the current cash value that's in the policy. We're going to move it over to Pacific Life. And you're now going to be in something called an indexed universal life instead of a whole life. So immediately we moved it. Can you guys see the numbers? Is that pretty clear? Okay. So in year 5, 5-year cash value, it's showing 371. Okay. But take a look over here. We automatically went to an increasing policy. So day 1, moving the money over, he now has 1.2 million of coverage. Okay. So from 1 million of coverage to 1.2 million. 5-year cash value is 364 in this scenario, sorry, 371 in this scenario. 10-year cash value is 519,000. So now the death benefit is 1.5. Now take a look at this. By 20 years later, the policy should have about, is that 891,000? It's literally too small for me to see. 891,000, and the client now has 1.8 million of insurance. But here's the crazy thing. Because of how powerful this product is, client doesn't need to pay any more premiums ever again. So that $7,000 that he was paying, he stopped paying into this new policy. Okay? So 10 years later, 20 years later, 30 years later, look how much life insurance he's got for his family now without paying any more premiums at all. So we literally more than doubled the amount of coverage. So by doing this swap, client goes from having $1 million of insurance that never grows. Client has to pay for 8 more years versus paying nothing for the rest of the time this policy is in force. Okay, does that make sense? Now, I'm going to show you the craziest part to this. So this was illustrated years ago when I wrote this policy. We used to illustrate at 9.5%. We're no longer able to illustrate 9.5%. We now illustrate at like 5 or 6% just because of insurance company regulations. But I want to show you the craziest thing. So this over here is the actual client statement. And this is, I think, was 5 years later or maybe 8 years later. I don't see the exact date. It's 2021. Okay. So there's 786,000 of cash value here when we only predicted it would have like 500,000. So this was the actual return that the client got over this time period. Does that make sense?
Yes, this makes sense, but I'm a little confused about the premium. So he doesn't have to pay a premium when he switched over? I don't get that.
Nope. So,
Why?
so when I ran the illustration, number one, the way we structured this policy, we structured it to have essentially lower fees, and we also structured it so that the cash value is not just earning dividends, but it's now in different indexes. So you see how over here you have different investment options. So there's a fixed account option, and then there's something called a 5-year high par 5 index. And so with Pacific Life, they have an option that over a 5-year period, your money is essentially you're not in the S&P at all, but what they're doing is they're measuring what the S&P does without dividends. And then there's no cap on how high you can go, but over that 5-year period, they're measuring what the index did and they're crediting your account versus in the whole life policy, they're giving you a percentage and then they're going to give you dividends. And those dividends are usually going to be 4, 5, maybe 6%. Does that make sense? So now the cash value is able to grow more, and there's more potential and more opportunity to grow that money that's in the policy. So that's why like understanding a policy is so, so important. And when you're looking at term versus whole life versus universal life versus index universal life, what's important is not just to believe what an agent is telling you, but to really believe how the policy is structured, what the policy can actually do. And that's why I think this is so powerful for you guys, because again, there's no bad policy. There's nothing that's like, there's no bad way to buy insurance. I think having insurance is a very powerful thing. I think what's bad, let me just talk to you guys again. I think what's bad is when someone doesn't have life insurance at all. So if someone says, this is too complicated and I'm just not going to have insurance because I don't know which one I should get, and then they die without coverage, and then the family's suffering. There's the GoFundMe answer. So it's better to have coverage than not have coverage if you have a need for it. But now it's understanding all the different kinds of policies and all the different companies that are selling policies, and what are you using a policy for? And you want to design something for you that makes sense for you. And my goal here with you guys is for you to learn this stuff and literally know it like second nature. So if you make a decision that you're going to have term insurance, then I have term insurance because of this reason. This is how I'm using it. This is what I'm doing. And I know exactly how it works. So I know that this is what my policy does and doesn't do. And I know that at this period of time, I'm no longer going to have coverage, but I'm getting really good at my investing skills, and I'm going to self-insure because I'm going to build my wealth through investing. That's a powerful way to do it, but you at least know. So now no one can say, well, why did you buy term insurance? That's stupid. No, it's not stupid. You're making a decision for yourself, and it doesn't matter what other people think. So same thing with whole life. There are reasons to go with whole life. If you understand how it works and you fully buy into, like, this is how it works, I understand it, and I've chosen to do this because I believe it's best for me because I'm educated about it, versus my agent was really good or my agent talked me into something. So Marissa, is it okay if I use you as an example?
Sure, absolutely.
Okay, so Maritza, you want to kind of share a little bit about what we were talking about so that it comes from you, not from me, and then we can dive in a little bit.
Talking about my 2 policies that I
Yeah.
have.
Yeah.
So I guess I originally engaged with a financial planner to kind of buy this insurance for myself. And when I switched jobs and I had an advance on my income, he's like, well, why don't we just up your policy? And I literally thought he was just going to increase the existing policy. And what he ended up doing was creating a completely different policy. And I'm like, wait, why am I doing this? I had kind of reviewed all that stuff with Hanna. And now that I know that, I can realize that I can just get licensed and make money off my own policies. And honestly, I don't have kids. So I don't really need a lot of life insurance personally, because it's really just a nice to have for the rest of my family. If something were to happen to me, my sister's my Benny, and she would just divvy it up for the family. And it's like a awful to say, but a bonus for them, I guess. Since I don't have any kids, so I didn't really need that much. So I'm overinsured when I don't need to be. But part of it was, yes, I had my first policy was more of a retirement plan. So I'm looking to optimize that.
Right. So in her situation, and this is so common, this literally just happened yesterday with Kiana, by the way, another plat that was sending me some policies that was purchased by a company, and they were like these massive policies, and they're not putting enough money into it to justify the amount of coverage. So there's 2 ways that people will sell a policy. Number one is if you come to the table and say, I'm married, I have kids, and if something happens to me, I need to replace my income. Okay, so example, I make $100,000 a year, and I have a mortgage, and I have 2 kids, and my family relies on my $100,000 a year. So if I die today, the $100,000 from my job stops, but the mortgage doesn't stop. The kids, education and all the expenses of the house don't stop. But all of a sudden, my spouse doesn't have my $100,000 of income, and now all of a sudden they're having to sell the house, they're having to do a GoFundMe, and they're in panic. So what I would do is I would purchase. I would say I need $1 million of coverage so that if I pass away, my family has $1 million, and they could take $100,000 a year to replace the income that I was making from my job. So in that case, if I have a need for $1 million of coverage, I'm going to purchase $1 million of coverage. And now the question is, do I want that coverage temporary or do I want it permanent? If I want it temporary and I'm like, look, I don't care what happens once my kids are out of the house, I just want to protect my income for the next 10 years or the next 20 years, then that's when a term insurance policy can be really good. But if I say, well, no, I always want to make sure that I'm leaving life insurance for my kids. So even after the 10 or 20 or 30 years, like I want to have covered, I want to leave a legacy forever, and I don't want to rely on my investments. I want to have coverage for that. And then I'm going to have my investments and I'm going to live off of my investments for myself. But I always want something to leave to my kids. Well, then you want permanent insurance. Okay. And then it's the decision of, do you want, what kind of permanent insurance do you want? But the way that Maritza was purchasing insurance was not necessarily because it's to cover her income. It's, hey, I understand that this is a powerful tool where I can actually build savings and I can actually use it to supplement retirement because it's, tax deferred. You can take out loans that are not taxable in retirement. So it's a powerful, powerful tool. So if you're going to do it the way that Maritza did it, then the way that you want to design that policy is you want to have the least amount of life insurance so that your premiums are mostly going towards building up your cash value. So when we looked at her case, I was like, whoa, why do you have so much coverage? And I understand why the agent would do that, because the agent, literally, by the way, when she wanted to put more money in, she could have put that additional premium into her current policy, but the agent wouldn't have gotten paid any more money. So because she doesn't understand this stuff, he's like, let's get another policy. So he gets paid another commission, and now she's paying for more insurance that she doesn't really need. Rather than, when we ran some numbers, so Brett and I actually were up for like 2 hours, literally running numbers and running different scenarios. We ran it with 3 different carriers and trying to see how we can get a policy with the lowest amount of fees that she can put the most amount of money. And what happened is the cash value potential for growth was so much more. So now the question is, what are we more concerned about? Getting a policy with higher death benefit where the agent makes more money, or getting a policy that's designed perfectly for her needs, where it's less commission, but it's going to put hundreds of thousands of dollars more into her pocket, right? And then, of course, thanks to Kiana, one of the things that we're doing with this group is we're not just saying, hey, Maritza, let me write this policy for you, but it's, hey, we're going to teach you, we're going to help you get licensed so that you can then learn this yourself, do it for yourself, become your own agent. And now, again, you're getting paid the commission. By the way, the commission's pretty nice. It's even as we designed it with lower death benefit, insurance is a highly commissionable product, no matter how you look at it. So you can't avoid the commissions. It's not like if we run these numbers with Maritza and we say, okay, here's a policy from Nationwide, or here's a policy from Pacific Life. And she says, all right, well, cool, I'm going to go direct to Nationwide and cut you out. The commissions are not cut out. There's nothing different about the policy. So we can't avoid a commission in a policy, but what you can do is you can get that yourself and manage the policy yourself. Because one of the things that, that I say, and I know that Kiana says, is no one's going to care about your situation more than you. No one's going to care about your policy, your financial situation, your financial stability more than you. And that's why I think taking ownership is such an important thing. And again, not only, even if it was just, we're going to help her with her own policy, still going to be way better than what she currently had, but it's the education, it's understanding it. So you're in control. That way, when you sit down with an insurance agent, if you don't want to do this for yourself, you know this stuff and you're like, okay, well, this is what I want. This is how I want it designed. No, I want lower death benefit. I want more money going towards me. These are the indexes that I want. Like, you being in a position of control, even if you don't want to do it for yourself, puts you into a powerful place. But being able to do it for yourself, I mean, that's next level power. That's next level, in my opinion. Veronica, you have a question.
Yes, I really like, I actually think that I am in a similar boat to Maritza, except that I have kids. But I want to like build more cash value for retirement. So I was wondering if you could do like a scenario of, with the money that I feel like I can put in, what
Yep.
that would look like.
Absolutely. Let's do that. That's actually exactly what I wanted to do. So I love that you just said that. All right. So I'm going to pull up one of the carriers that I really like. There's a bunch of them that I like. But I'm going to run, let's see. And this is one that I actually own myself too. So let me just take you guys through. Okay. So this is Nationwide. Okay. And you guys probably have heard the jingle, Nationwide is on your side. But the question is, do you know how these products actually work? All right. By the way, how many of you guys have heard of Nationwide? Oops, what did I just do? Hang on.
And then go back, you hit the wrong one.
Illustrations. Okay, that's Enforce. Okay, here we go. Online tool. Okay. So I have several policies. Nationwide is one that I have. Tell me if you guys can see my screen as I keep going through this. Okay. By the way, when I first got licensed, I literally played around with this thing for hours and hours and hours and hours, like every day, just trying to see different scenarios of what it would look like for me. And I just fell in love with the product. So Veronica, let's use an example. What state do you live in?
Florida.
Florida. Okay. So what is your age?
37.
37. 37 is a great age to buy this policy. And for your health, are you on any medications or any diagnosis? Nothing. So let's go with preferred plus. No diagnosis of anything, no health issues. Okay. So we're gonna look at this from two perspectives. So she said one thing, she's got kids, and so she wants to have coverage for her kids, but she also wants to build money towards retirement. So we can use something called the blended scenario, where we can use term and this policy to give her the most amount of coverage that she possibly needs, but to make this policy sing, to make this policy do really great things. So tell me, like, how much do you think on a monthly or annual basis that you want to be putting away towards your future goals?
Towards insurance, I'm thinking 500 to start.
So not towards insurance, towards your savings and retirement goals.
Oh, right now at about 1,000 per month.
Okay. 1,000 a month. Okay. So if we were going to do 1,000 a month, okay, and we're going to assume that she's going to pay into this, let's say till age 65. Make sense? Okay. Is that a good retirement age, or do you want to go younger?
Probably younger. That's
Okay. Tell me what age you want to pay into.
Ideally, I think 55.
55? Okay.
Mhm.
So if we wanted to pay until age 55, this right here where it says face amount, this right here, it says minimum non-MEC. So what this means is this is the minimum amount of coverage that we can buy that doesn't violate the IRS guidelines. Okay, now let me give you a history of why this is important. So back in the day when these policies were first being sold, a lot of very wealthy people would want to put their money into a policy like this. And let's just say they want to put in 100 grand a year or $1 million a year, but they wanted to have a $50,000 life insurance policy. And so they were kind of using this almost like a tax shelter, because they could put all this money in and not pay taxes on the growth. And so the IRS came out and said, no, this is life insurance first. So you have to have a certain amount of life insurance in order to have this policy. So by using the minimum non-MEC, this allows us to get the minimum amount of insurance. So it minimizes the fees and it maximizes the amount of money that you can actually build cash value with. Does that make sense?
Yep.
Okay, so I'm going to design this the best way possible to build the most amount of cash. Okay, so I'm going to use CVAT to stuff the most amount of money into a smaller policy. We're going to go $1,000 a month, and here's what I'm going to do. by age 55, so we're going to increase the death benefit to 55, and then we're going to make it level from age 56 all the way through, because as we pull money out of this policy, we're going to kind of suck the life insurance out of the policy. So I'm going to show you how I'm going to do this, okay? So you see how it says here, avoid MEC. This means that this will not become a taxable contract. And we're going to go ahead and this right here tells you what index options we have with Nationwide. Okay. So wait, hold on. Am I using the right? Wait, I got to change products. I'm going to use their newer product, which is called the New Heights Indexed UL. Okay. And this one is a little bit better. So same numbers. Okay. So these are the index options that we have. Like we have 1 year capped S&P 500, 2 year S&P 500, 1 year JP Morgan Mosaic, right? You've got the Zebra Mosaic. You have their Choice Plus index options. Okay. So we're going to go ahead and we're going to use the 1 year Choice JP Morgan, and we're allowed to illustrate all the way up to 7.22. Okay. So we're going to do that for the purposes of this policy. Okay, and now what I'm going to do is I'm going to solve for an income stream. Now, we stopped paying into it by 55. When do you want to start taking money out for retirement? At 55 or 65? Or when do you want to start taking money out of this?
So it's a little tricky because I would ideally, so I currently own a home, but I want to sell it and eventually just not finance through the bank, not get a mortgage and be able to either use my investment funds, take out a loan, or use something like this. Does that make sense?
So you want to be able to borrow out of it whenever you want? Yeah, you can,
Basically, yeah.
so you can do that too, but I'm also going to show you using this as a supplemental retirement income stream. Okay, so for purposes of this, I'm going to put it at 66 just because you'll have higher numbers, but I will
Okay.
also go back and I can show you at 55. Okay, so I'm going to pull money out of here until age 100. Okay, and so on this one, you can add a long-term care rider, and the long-term care rider there's two things to it. If you add the long-term care rider, you'll have essentially the ability, if you can't perform 2 of the 6 activities of daily living, you can then take money out of the death benefit for that, but it'll lower your cash value. So for you, what I'm thinking is you probably will want to do a term insurance policy with living benefits and have this policy be juiced up as much as possible. So we're not going to weigh it down with the rider. Okay. But we'll use your term, and you want to get a different term. So we'll probably get rid of that prudential. We'll get you term with living benefits for 30 more years. Okay. And let this policy just have as much horsepower as possible. Okay. So let's go ahead and see what this looks like.
Okay.
Training. All right. So Manny just popped in over here.
What's up, guys?
All right. So if you take a look over here, this is showing $1,000 a month. Okay. And what this does is it's buying me $419,000 of life insurance right away. Okay. So again, having kids, and we didn't get into your personal numbers and we won't do that on here, but if you needed to have $1 million of insurance or 2 million of insurance, we can supplement that with term. Okay. Low cost term. Okay. But you see over here, which says accumulated value and then net surrender value. This is so important for you guys to understand. So the accumulated value is how much you actually have in the policy immediately, but what's accessible is the net surrender value. Okay. So in this case, in year 1, you have access, after you've paid the 12,000 and you'd have access to 90% of this number over here. After 5 years, okay, you would have access to 49,000. After 10 years, you have access to 128,000, okay? After 15 years, there's 235,000, okay? Now, if you take a look at here, oh, okay, here we go. So if you were to get this policy and you'd pay into it from age 38 till age 55, and then you stop paying into it, okay? So you put no more premiums into this. This policy would be able to give you $39,000 a year in loans from age 66 all the way through age 100, okay? So this right here, because it's a loan, it's not taxable. Now, here's the other thing, okay? So it's going to get paid back by the death benefit. So you're pulling out these loans. After year 10 with Nationwide, there's no interest on this loan. So there's no interest and there's no taxes. So you could pull this out all the way from, call it 66, all the way through age 100. And then you pass away at any of these points and it's simply paid back by the death benefit. Does that make sense? Okay, so
Hey, Hannah,
Mhm.
point out that you ended up putting in that 30 years or 20 years or so, you put in $216,000,
yeah,
but you ended up taking out 1.365 million tax-free. And that's why people use these is it's tax-free growth. And well, it's tax deferred growth, but it becomes tax-free through the death benefit. Does that make more sense, Veronica? I saw you were a bit confused, but ask questions that you have.
So, yeah, I'm sorry, I have a headache. Not because of this, not because of this. I just don't understand. So I can take out a loan after 10 years without
No.
interest, without
You-
interest.
without interest, correct. In the first 10
Right.
years, they're going to charge you 1%.
1%? Okay, okay,
Mhm.
now I get that.
Does that interest get paid back into the policy or where does it go?
No, the 1% actually gets paid to the insurance company.
Okay.
Oh,
Yeah.
okay.
So if you're borrowing,
But there are policies. Oh,
go ahead.
no, I was just gonna ask, there are policies where you can take out a loan prior to the 10 years without getting interest
So
charged.
So Pacific Life, which is my probably my second favorite. Well, I don't know. Nationwide and Pacific Life are my two favorites. But with Pacific Life, they're going to charge you 0.25% on a loan versus Nationwide is going to charge you 1%. But after 6 years with Pacific Life, there's no more interest. With Nationwide, it's after 10 years. But here's what we're going to do. Okay. So we're going to compare this to Pacific Life and see. So anytime I'm ever making a recommendation, I'm always going to look at different companies. So I'll run it with one and then I run it with another. And then I want to see maybe 3 different scenarios to see which company for this scenario is going to give me the most amount of cash, the most amount of insurance, and be essentially the best case scenario. So the difference between Nationwide and Pacific Life, let's take a look real quick, is that you're going to have higher cash value in the very beginning. Okay, so you have access to your money pretty quickly. So if you take a look over here, you have access to already 2,000, 90% of this number over here. Okay, so remember these numbers. If you guys want to write it down, because we're going to compare it now to Pacific Life. So 15-year cash value is 235. 20-year cash value is 359. Okay, you guys got those
Oh, right.
numbers?
I remember the other question.
Mhm.
That's why I made the confused face. So the loan, can you scroll down?
Here?
So when you were talking about taking out the loan after the 10 years, that's different from the actual accumulated cash value.
So if
That's
you
what
want,
I got confused.
so like, let's just say that here you are in year 10 and you've got 129,000. There's 128,000 of net surrender value. And let's say you wanted to make a down payment on a house and you don't want to take the loan from the bank. You can go right over here and you could take a loan for up to 90% of this cash value over here. So you could take out $100,000 loan. If you did it in year 10, they would charge you 1% for that loan. If you did it in year 11, then you would have zero charge for that loan. Okay. And then you could, what people will do is they'll take a loan from here and then they'll make those payments back into the policy versus taking a loan from the bank and making payments to the bank. So people will finance their cars through the policy. They'll finance their homes through the policy. They'll finance their business through the policy. Okay, so you've got this tax deferred growth, but you are able to access the money, right? So if you have a 401k or an IRA, 401k at your company, you could take loans from. But if you have an IRA, you can't take those loans out of your IRA, right? You have to wait till 59 and a half to be able to get your money out of that policy. And then you're going to pay taxes on it if it's an IRA or a 401k. Maritza?
If you take a loan, is it still accruing value as if you hadn't taken the loan, or it does decrease your returns?
So
Okay.
in this one over here, they're going to remove it out of the policy. There with Pacific Life, you have something called alternate loans. So alternate loans, alternate loans allows you to basically keep your money in the policy. They're going to charge you a higher interest rate. So they might charge you 4 or 5% on that loan, but the money is now staying in there. So now if your money is earning more than 4 or 5%, you have a positive arbitrage. Okay. So you have to decide, do we want a standard loan? By the way, great question. Okay. And you're in control over those things, but you have to make sure that the company has those types of loans available. So, all right, I'm going to now show you the same thing. So remember 39,000 of income. Okay. Brett, you want to write this down so we can compare 39,000 of loans.
I've
We've
got
got-
the numbers.
Was that?
I wrote the numbers down.
Okay.
Okay.
So 20-year cash value is 359,000. 10-year cash value here is 129. Okay. So now we're going to do the same numbers, okay, with Pacific Life, and let's compare. This is why it's so powerful to understand this stuff. See, like if you go to a company, like let's just say you're going to Northwestern Mutual or New York Life, right? They're going to show you what they can sell, but they're not going to compare different carriers. Like they're going to just sell you the product that they have. So that's why taking this into your own hands and learning this stuff, so powerful.
Veronica, you got any more questions? Yeah. While she's doing that.
I had
good.
a question. I forgot. I'll let you know if I remember.
Okay, please do.
All right. So this is my other favorite carrier. And, you know, I have 2 policies with this company. I have 1 policy with Nationwide. And I have my family's policies with both companies. And then there's a third one that I really like as well, but we're not gonna have enough time today to get into that one. But this is Pacific Life. This is one of the premier carriers in the country. A lot of Fortune 500 companies use this company. Okay, so we're gonna say same thing, age 37. Okay. Female, we're gonna say super preferred, no health issues. We're gonna go CVAT as well. We're gonna say minimum death benefit. We're gonna go increasing until age 55. And then we're gonna go level from age 56 through year 100. We're gonna say same thing, $1,000 a month. And we're gonna pay into this until age 55. So all the same numbers. Follow me? Okay, we're going to use our 1-year high cap and index account, which is going to illustrate at 7.08. And we're going to take out loans from age 66 to age 100. So everything the same. And we are not going to use a long-term care rider here. Let's see. Okay, we got terminal illness rider. Yeah, we're not using the long-term care rider here. All right, now let's see how that looks. And I have no idea which is going to be better because like I said, in almost every single scenario, it's going to come out differently. If I had time, I would get into the third carrier, but this is just giving you guys an idea of how this world works. Huh? All right. So I think I spelled your name wrong. Sorry. Okay. So, well, this one over here, it gave me a $205,000 death benefit. So it doesn't let me put all the money in here. So I'm going to go back. I'm going to go back and raise the death benefit so that we can, let's see, how do I get back in there? Okay. Oops. How do you go back in there? They just
Yeah, they just changed it. Input right here.
input. Yeah, they literally just changed everything here. Okay. So, Brett, what was the death benefit?
The only thing that changed is
419.
419. Okay, so I'm gonna just go ahead and match the death benefit here.
Well, sorry, 410. It was 419 after year one.
410.
the reason you ran it that way is because the CVAT. Theirs automatically does CVAT and Nationwide does GPT automatically.
I changed that to CPAP
Oh, you
too.
did? Okay.
Okay, so let's see if this makes a difference. If I give it 410,000 and no, it's not letting me do that. Okay. Oh, here we go. Sorry. Specify coverage. And we're gonna go 410,000. So we're gonna match what the insurance was over there. And let's see if that will allow us to do 12,000 a year. Right, so what that was saying is if we only had 200,000 of coverage, then you can't put in $1,000 a month, right? So that's why you have to like know these numbers, because if the death benefit is too low, you can't get enough money into the policy to do what you want. So you've got to design, like, imagine you got to design the bucket to be big enough for what you're trying to put into it. Okay, so here we go. So this is allowing us to do 12,000 a year. And over here, so same thing. So, oh, on this one, look at that. So your net surrender value is actually more here. Okay. So net accumulated value is 8,700. Net cash value with Nationwide was like 3,000. So you actually have access to your money faster here. And then in 10 years, you have 117. What did it have at Nationwide in 10 years?
129. Year one over here over at Nationwide was 2,390. So you actually have 3,000 more.
Yep.
Net surrender at year 10 is 128,561 here. So it's a little bit more over there.
And what was it in 20 years?
20 years. Are we on? Yeah, year 56. Let me see. Year 50, is it 55 or 56? Yeah, 55 was 318. 264.
318. So you have more with Nationwide short term, but you have more with Pacific Life long term. Now let's see. This is the kicker. What were the loans at age 30?
32.
Okay. So in this scenario, for a 37-year-old female in perfect health, Pacific Life is actually going to give her more for her money. Okay. What was the cash value in year 30?
Year 30. Where did that go? Okay, I didn't take a picture of that.
Okay. So 583,000 in year 30, and this gives you $37,000.
Year 27 was 550,000. So that's the
Oh.
yeah. So
Okay, year 27. So there's actually more cash value in Nationwide, but this is going to give you a higher withdrawal rate. Okay. So in my opinion, I would probably go with Pacific Life in this scenario because it's going to give you 37,000 a year all the way through age 100, right? And there's still $100,000 left in death benefit when you pass away. Okay, that's if you live to 100. If you live to age 90 and you pulled all this money out, there's 383,000, sorry, there's 510,000 left of life insurance. But you see, we're actually like sucking the life insurance out of here to give her the highest amount of loans. But here are some benefits to this one. So the loan charges here are only 0.25%. So whereas the other company was giving 1% loans, this is giving you 0.25 and only for the first 6 years. So after year 6, you're now at 0% loan fee. So looks like with this one, if you want to pull out loans in the first few years and you know you're going to do that, 0.25% loan fee, okay? And after 6 years, it's 0. Now you also have the alternate loan here available, and the alternate loan, they're going to charge you, call it 4 or 5 or 4.5% on the alternate loan fee. But then if your money's earning 7%, they're going to leave the cash in this account, still earning interest. So you could basically take a loan out and now you can buy real estate, or you could make other investments, or you could do whatever you want while having your money grow in 2 different places. That makes sense? Super powerful strategy. Okay. So, and just to kind of give you an example on that scenario, there's minimums and maximums that you could work with in these policies. So in this one, lot of lingo. Okay, so on this one, the minimum premium is only $2,700 a year. So let's just say if Veronica got this policy and then God forbid next year she's like, Hannah, I can't put in $1,000 a month anymore. You know, my job, I got fired, or my business has been slow. She can go as low as $2,700 for the year and still have this life insurance policy. Now, maximum, she can pretty much for 7 years, if she wanted to stuff this full of money, she can go up to $25,000 a year and really overfund this policy and then kind of stop paying for it. So there's all these different ways that you can design this. Okay. So again, we're at 11:03, so I don't want to take up more of your time, but you know, once you understand this, like deep dive and understand, first of all, you could build the best possible scenario for you, and you could sample all the different companies and figure out, like, is this the right strategy for you? Because it might not be. You might be someone that says, you know what, this is really cool, but I think I can do better with my money on my own. I'm going to get term insurance, which, by the way, you can also shop the term carriers. The difference between Prudential, because we could do Prudential, or we could do Pacific Life Term, or we could do Transamerica, or we could do Banner. There's like 100 different companies. So you can compare. I want to get the cheapest term, and then I want to invest the money on my own. Or, well, I want to do a combination of that. There's so many ways to skin this cat, but I think the biggest thing is transparency and being educated and understanding every company like yourself, so that you know what you're doing and you know what you're getting. I believe, like, look, we all make choices in our life. And I'm going to give you guys a silly example. You could go buy a watch right now for $50 easily, okay? Or you can buy yourself a nice Rolex. And you know the Rolex, you know you're spending more money on the Rolex. And I don't care, there's going to be people that say, oh, you're stupid for buying the Rolex, you should have bought a $50 watch. But if you're like, you know what? This is a piece of jewelry. I'm going to pass it to my kids. There's a reason I'm buying it. Now, I can tell you that there's going to be a lot of people that will not agree with your decisions. My husband does not agree with my decision to have a Rolex. He's like, I don't even have a watch. Why do you need to have a nice watch? That's just a dumb thing to do with your money. But if you know why you're buying it, you make that decision for yourself. Does it matter what other people say? You've got to get educated for you so that you're making the right decisions. Like, hey, I want to have coverage for the rest of my life, and it's important to me. So now I don't care that someone says that that's stupid, because I did it empowered, I did it educated. Okay. So that's why I think this is going to be so important. And we're going to deep dive even more. Again, I'm sorry I'm going over, but We're going to teach you the ins and the outs of all this stuff so that you're empowered and that you know this for you. And then if this is something that you want to offer to people that you know, friends and family, and like, I know for me, one of the first things I wanted to do once I understood this, I was like, I want my parents to have the right kind of policies. I want my kids to have the right kind of policies. So I got into a position to where I know this stuff. I'm not having to believe or listen to anybody else. I don't have to read the blogs. I don't have to listen to people's opinions. I'm going to get educated for me, and then I'm going to make the right decision for my life and for the people that I care about. Does that make sense?
It does.
All right.
I'm
so-
in. I want to do this.
Isn't it great? Like, education is so powerful. That's why I love what Kiana's doing with educating you guys about your money and making the choices for you. Like, I don't think there's anything more powerful than taking control over your wealth and your health and being able to make decisions for your life. It's called being the CEO of your own life. So anyways, hope I added some value today, and we'll deep dive again next Thursday at 10 o'clock. And we can go ahead and we'll use the other carrier. And we can also run different term rates as well with all the different carriers. So you can really, really understand the stuff.
Wonderful.
All right. Okay.
Awesome.
you.
Thanks for being with me today.
Thanks,
See you guys.
guys.
Thank you so
Bye.
much.
All right. Bye.